but the markets wouldn't suggest as much because the standstill across major assets continues. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And it's been an interesting set of trading days here in recent weeks because it would seem like there was plenty that was happening in the markets. It would seem like there's been major events that have implications for policy, implications for the economy that have occurred, but not if you look at the way the financial markets have performed. And then we face this week, which will present us with something even more confounding, perhaps. On the one hand, a flurry of critical event risk, a packed economic calendar, ample opportunity to get some of a directional steer on where stocks, bonds, currencies might be going. And at the same time, another midweek holiday. U.S. market's going to be shuttered on Thursday for the Independence Day holiday. Wednesday will be a half day across many key exchanges. Friday will be a half day across at least some of them. And so you end up with a situation where you get thin liquidity likely, low levels of participation likely, and choppy price action likely, even as you get this much more significant flow of information than we've had in recent weeks. And so you end up with, again, a kind of strange backdrop for how some of these recent ranges will resolve. And it is with that we focus on what is coming next and find that perhaps the main touch point that we are going to once again find ourselves focused on is the Federal Reserve. Because the thrust of the event risk seemingly in front of us again captures that narrative more than any other. And so what we're going to do here first and foremost is get a little bit of a handle on where we've been and then try to see precisely what could be an influence to get things moving around a bit. So this is the way that the markets looked last week and the prior week across key assets. And what you'll notice immediately, stocks were down a little, having been up a little. Gold was up a little, having been down a little. Absent the Japanese yen, which had another week of losses against the greenback, the overall dollar story has been relatively listless. Looking at the euro, the dollar's main and most liquid counterpart as a kind of stand-in for the overall U.S. dollar index, which of course is heavily skewed toward the euro in any case. Last week, euro's up about 0.1%. This week, or the prior week rather, down 0.1%, which of course means the dollar was down a little and up a little. So the story seemingly very non-committal about the only thing that is here to be extracted, other than, of course, crude oil continuing to march to the beat of its own drum, is the shifting dynamic of the yield curve. Notice here that last week there was a very strong rise in long end rates. The 10-year up 3.4%. The front end, relatively listless, up only 0.4%. And what this essentially comes together to show us is something of a steepening, but a very particular kind of steepening. The kind of steepening that anticipates more inflation and thereby higher interest rates in the future. That portends a situation where perhaps the Federal Reserve might cut rates as anticipated, but maybe the floor on those cuts has just moved higher. Maybe it has less scope to ease. What's interesting is that the actual calculus, as we'll see momentarily, for where rates are going this year and next has barely budged. So whatever adjustment this is, perhaps takes us into 2026, 2027. But what that means in the context of what's going on here currently seems to be unclear, because the bond market in some sense stands alone. We are not seeing this show up as either risk on or risk off for stocks. We're not showing it in gold, which is obviously something that is historically sensitive to changes in interest rates, in so much as it yields nothing. We're not seeing the response in currencies by and large. Again, the yen is kind of onto a story of its own. And so what we end up with then is a situation that, on the one hand, seems like it might be telling us the beginning of something, but on the other hand, other markets don't seem to care about it yet. And with that, we're going to have a look at what might tip the scales this week. The first thing actually comes to us from outside of the US, and this is Eurozone inflation data. This is going to be very important because, of course, we've just had a very interesting set of developments in the Eurozone. France had their snap parliamentary elections over the weekend. The results were almost identical to where the polls sat. The outcome had the National Rally, which is the strongly right of center bloc, emerging nominally victorious and scoring just over 30% of the vote by the latest numbers. We had the New Popular Front, which is the left of center, strongly left of center bloc, come in second. Again, just under 30% of the vote, looking like about 28 in the final outcomes here, or at least as the tally gets finalized. So again, about a third of the vote. And the centrist bloc, led by the current French president, Emmanuel Macron, the ensemble bloc, coming up in third with about a fifth of the vote. This is, of course, exactly in line with what was expected. And the markets have kind of a strange day around it. So we end up seeing a situation here, looking at the euro, where initially you get a very strong euro rally, perhaps around the idea that we didn't get an unexpected outcome. This was what the markets had baked in. So perhaps a bit of relief here around the idea that the unexpected was not ultimately on the menu. We head into the next round of these parliamentary elections next week. There seems to be a very strong sense that where we end up is some kind of deadlock. Because, of course, if we're going to split the electorate into thirds, then we're ending up with nobody really having the kind of unilateral ability to push through policy one way or another. And of course, it seems relatively unlikely that the hard left and the hard right are going to make friends. It seems relatively difficult to imagine that the hard right and Macron are going to make friends. Maybe there is a coalition of Macron and the hard left that's on the menu. Maybe there's not. But the overall story seems to be one of parliamentary deadlock, maybe a hung parliament going forward. What this means is that for France, the second largest economy in the Eurozone, it will be devilishly difficult to pass things like fiscal policy measures, to pass a budget, for example. The foreign affairs piece is probably unchanged for the most part because, of course, Mr. Macron himself doesn't get termed out until 2027. And so things like defense policy, foreign policy, all that probably stays as is. But fiscal policy becomes much more challenging to get right, or at least to push through some sort of singular vision. And so what this means, if the economy is starting to turn, as might be suggested by the latest set of PMI numbers, which of course were very disappointing relative to expectations, and suggest that the post-recession catch-up in the Eurozone that began in the first half of this year may be running aground now, that to backstop the economy in such a scenario, you might need to rely overwhelmingly on monetary policy because you're not going to get a convincing lift from the fiscal side. As a matter of fact, we saw, for example, the alternative for Germany, the hard right in that country, cheering what happened in France, saying, well, this is a great model for us. And the next time that Germans go to the polls, we may in fact see a similar sort of splintering. We've just seen a preview to some extent in the European parliamentary elections, which of course kicked off this snap election in France. We didn't see the hard right win majorities in European legislatures, but region-wide, that is. But the share that they represent have certainly increased. Their power has certainly increased. This is why Mr. Macron seems to have been compelled to hold a snap election in France to attempt to re-burnish his mandate. So what we're looking at here is a situation where the ECB in an economic downturn might have to do more because fiscal authorities are tied in knots arguing with each other. That, of course, is why this inflation data is so interesting. The expectations are that we're going to come in from 2.6 to 2.5% on headline CPI. If we take a look at the makings of CPI, at least as far as the May numbers had it, we can see that the big chunk now is hospitality. The influences from food have faded, from energy likewise. Here's the influence from energy right here. It's been, of course, run down significantly. Here's where food has gone. Last year, this was by far the biggest contributor. You can see that right here. Here was energy at the sort of onset of the war with Ukraine and Russia. Here's food, the sort of remnants of the COVID shock seemingly here, because this was something that happened across global economies, this food shock. But now you've kind of evened things out to a large extent, and the more balanced, more even basket of where inflation is coming from seems overwhelmingly focused here. Now, there's a smattering of things here in the transport category, in the sort of miscellaneous and assorted category, but it is here, seemingly, that the most impactful disinflation is there to be had, because, of course, if the economy is turning, it is this kind of discretionary spending that is likely to unravel. Now, there might be some way to go there. We are, of course, in the middle of summer. This is the European vacation season, and there's likely to be at least some degree of uplift on hospitality from traveling and tourism and leisure and so forth. But there does seem to be a relatively clear path toward disinflation here if the economy continues to evolve as it is expected, or at least as it could, if, in fact, the turn in growth has been made in earnest. And so it'll be really interesting to consider then, if we get evidence of continued disinflation, given the political backdrop and the onus on the ECB to act more forcefully, perhaps, with that fiscal back story, where the euro heads next. And of course, if this capitulation on a retest of 108 ultimately is going to hold and be stage setting, then a break of 107 might then expose this low from back 10 weeks ago, mid-April at 106.29, 106.30. And if you crack that, then the next leg in this down move from the beginning of the year, where you can see the down moves have, of course, been deeper than relatively shallower upswings here, hence lower highs and lower lows. The next leg of that might be, well, here. Take us in for a test near 105. The next bit comes from minutes from the Fed's June monetary policy meeting, where, of course, they updated this table that you see in front of you, the summary of economic projections, and ultimately updated it to be less of a dovish statement. You can see here the number of rate cuts on the menu for this year, down from 3 cuts to just 1. A little bit more of a adjustment into next year. Inflation expectations revised higher, both for this year and next, and both for the headline and the core, even as growth is left exactly unchanged. And the long run rate for the Fed funds rate, so where the floor is, up from 2.6 to 2.8%. In other words, the Fed almost considering here that we're approaching 3% on an interest rate that is neither stimulative nor contractionary. And so we're looking at a situation here that screams that higher for longer narrative that the Fed left with us in May, after inflation seemed to have stalled on the path lower. The key question for these minutes, and a speech from Fed Chair Jay Powell that happens at the ECB Central Bank Forum in Sintra, Portugal on the same day, will be whether what is being telegraphed here took into account the latest economic data. Because, of course, the day before the Fed revealed this to the world, CPI inflation registered lower than expected, and disinflation seemed to resume. 3.4% on the core. You can see here that's a meaningful downswing for it versus 3.5 expected. The headline also in lower than expected, which of course has since been confirmed by what's been happening in the Fed's more favored PCE measure of inflation. Most critically here, we sat at 2.8% on the core reading, which approximates this service sector area where most inflation now is locked up. As of the latest numbers, it's dipped from that standstill to 2.6%, which is a 3-year low. So the question for both Chair Powell and the message in these minutes will be, did they take May into account and still end up with a story that says we're disappointed in how slowly this is going, or they didn't take May into account, and so they've, since that summary of economic projections was released, become a little bit more confident in how much easing they can deliver and how soon that can occur. Of course, the main story here has to do with the seemingly intimate relationship between Fed policy expectations and stock markets. We can see here that for the better part of 10 weeks here, the market has been reacting to this higher for longer view. So we have the outlook for this year basically stuck at 1 cut. That hasn't changed much, but the outlook for next year, higher for longer, has become more dovish, which is to say that the market is saying that more cuts have been pushed further back, and that actually that more cuts on net will be needed because the Fed is going to have to do some degree of catch up because it didn't cut soon enough this year. So we can see for the past 10 weeks again, here we are, mid-April. The cumulative tally this year and next is about 80 basis points. It starts to move out to more easing next year, going from about 80 to 120 basis points. A significant increase, of course, about 40 basis points, almost 2 cuts worth more easing on net. And stocks, of course, like more easing. So they've rallied. For the past 2 weeks now, we've seen standstill, as we just saw on the performance metrics, and that is as this outlook has stopped getting more dovish. So, if the Fed appears to say, we saw the May data, we're still not confident, well, then that means that there's not more dovishness to enter into this forecast, most likely, which doesn't bode well for stocks. If the Fed says we did not take May into account, that implies they have some dovish relief in their baseline view that's probably now occurred relative to what they said at the last policy meeting, which might give this a little bit more of a risk-on flavor as it develops in response. And of course, it'll be economic data in this context that probably makes the biggest difference, which brings us to the U.S. jobs report. That's expected to give us 180,000 jobs added for the month of June, well within the recent range of 165 to 315, this range right here. Jobless rate unchanged at 4%. We're also going to get ISM data. We've already gotten the manufacturing piece, and it was weaker than expected, 48.5 versus 49 in the forecast. We're expecting to see a downtick in services as well, down to 52.5, a bit of a slowdown within the recent range of outcomes. And U.S. economic data has tended to underperform by an increasingly significant margin relative to expectations if we look at the data from Citigroup that we like to track. So the risk here is that, as with the manufacturing ISM, the service one will miss. This might miss. And then, of course, the question is, does the Fed find itself now more confident in disinflation? And so a miss is good news because it means sooner cuts. Or the Fed did take May into account, according to the minutes and what Powell says, and they're not any more confident, which means that these misses just mean the economy is going to suffer without Fed assistance. Hence the catch-up that we see here. Apparently a ramp-up of easing, not just a moving of it to a later date. And that ultimately bodes ill for stocks and gives us a sell-off. It is that which we are going to be following in the days ahead, and of course, try to make sense of the market reaction, given that it will be an incredibly liquid market, most likely, full of choppy price action and indecision as all of this is digested. And that is macro money for today. We have an abridged week this week. Normally we'd be here Monday through Thursday. This week we're just here Monday and Tuesday. And we'll be back next week thereafter because, of course, of the holidays that we have in front of us here. And that will, as usual, follow Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what follows thereafter and what it might mean. I'm likewise usually on for the price of truth on Wednesdays, though again, because of the holiday, not this week. Usually on Fridays for Futures Power Hour, though again, not this week. Sporadically, probably more so this week because of the market closures, on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.